Well, this is not one of the most pleasant times to talk to an audience about what's happening in the hog industry, especially if it's producers. Certainly we've gone through ups and downs as far as the hog industry forever, and we probably will continue to do that. So it's not unusual to find ourselves in this kind of position when we overproduce. I want to point out before I start that our major problem in this particular downturn of the hog industry is not demand. It's cost or overproduction. It's cost relative to what we had just a few years ago. For example, we've gone from $2 corn 5 years ago to a little above $4 corn at the present time, and it averaged more than that last year. We've gone from cost of roughly $40 or a little less for the average cost producer to somewhere in the low to mid $50 level on a live weight basis. So let's get started. I probably have prepared too many slides as far as the time that I have, so I'll go through some of them fairly quickly. But if you look at kind of the summary of what we've had, key driving forces as far as the hogging industry is concerned now are oil prices, biofuel policy, and the economy. High oil prices lead to high gasoline prices, high ethanol prices, high corn prices, and red ink for the livestock industry. A weak economy is doing the same, somewhat in reverse, without the decline in corn prices occurring too much. Look at what has happened here as far as the price that we receive for hogs and the cost. 208 prices were $260 above the 13-year average, but 208 production costs were $13.85 above that 13-year average. So there is the real problem that we have in this particular stress period of the hog industry. If you look at corn prices and cost of producing hogs based on the Iowa State data, notice if we have $4 corn, we have somewhere in the vicinity of $52 per hundredweight cost. And we just have to downsize the hog herd to get supplies in level with demand that can get us those kind of prices rather than in the 40s as we have now. Production efficiency. This is a very impressive record as far as anything is concerned. Look at what we've done. Since 1930, the U.S. has reduced sow inventory by 42% and increased pork supplies by 245%. Now, that's a record that anybody can be proud of. If we look at the pigs per litter, we've gone from 7 to 7.5 in 1980 to nearly 9.5 at the present time. So litters per sow per year, we've gone from somewhere in the 1.8 to really 1.6 to 1.7 in 1980 to 2 or a little better at the present time. Pigs per sow per year from around 12 or 13 in 1980 to 21 or something like that at the current time. Carcass weights, we've gone from about 170 pounds in 1980 to 200 pounds at the present time. And that's one of the aggravations we have seasonally this year. Our weights of market hogs at the present time are running 4 to 5 pounds above a year ago. Carcass weights are 3 to 4 pounds above a year ago. So that's adding to the solar supply, even though our numbers are down some. Annual U.S. production growth rate, about 1.5% a year. That line on there is drawn at 1.5% a year. Look at how well it fits the actual record. In the years when we have had less than 1.5% increase in pork production, we have had above a $10 per hog profit based on the Iowa State data. In the years when we've had above 1.5% growth, we've had substantial losses. Hog cycle. We are taking some of the fluctuation out of pork production as we measure it on a quarterly basis from a year earlier. Look at how we've funneled that down. But the interesting thing and the undesirable thing is we are not funneling down the fluctuation in price. Producers are still having to deal with widely fluctuating prices as we go through the cycles and seasonal patterns of the year. Price flexibility. And here, if we knew exactly what this is, we could be much more precise with you as far as just what we have to reduce the size of the sow herd to get ourselves back in a profitable position. If we're at that 2-to-1 flexibility, which means for each 1% change in price, you get a 2%, each 1% change in supply, you get a 2% change in price. In the mid-90s, it looked like we went to one, somewhere 5-to-1. In other words, an elasticity of roughly 0.2. For each 1% change in supply, we got a 5% change in price. If that's the one that we're still dealing with, well, then a 5% reduction in the herd will get us back in good condition. If, on the other hand, we're back to this one here of roughly 2-to-1, then we probably have to reduce the herd by around 10% to get ourselves back into a profitable situation for the average cost producer. International trade. This is a record that pork producers can really be happy about. China is the #1 pork producer. EU, Europe, 27 second, and USA third, and then smaller countries as far as amount is concerned. Top importing countries: Japan #1, Russia #2, and Mexico #3, as far as that was in 2008. And of course, China came in substantially above what they have been in the past in 2008. Top pork exporting countries: U.S. We are the #1 country now by quite a bit, and that's this is for 2008 that we have this data. This is USDA's forecast at the present time as far as change in pork exports this year. USA down 13%, and we certainly hope that we're not down more than that. On the data we have, we're always a couple of months behind. We only have data through March at the present time, and we're down 4 or 5%. But we're just now moving into the period of the year last year when we had those astronomical increases. And I believe one month we had actually 100% increase in pork exports from a year earlier. So I'm hoping that 13% is correct, and that will be an enviable record coming off of a 48% increase last year. 17th consecutive year last year of record pork exports. We have gone from a net importer of pork of nearly 7% in 1987 to, 15% or something like that, and I have a chart on that a little later, 15% net export in 2008. Excuse me. Most of the growth in the U.S. hog industry in the last 15 years we can attribute to foreign trade. Value of U.S. pork and byproduct value, last year it amounted to above $40 per hog. Think about that as far as the total value that farmers are receiving and how much that added to it. If we look at the supply of pork that we had domestically last year, even though we increased production 6.4%, we increased exports 48.6%, imports were down 14.1%. That resulted in 1.3% less pork domestically, Joe, last year, and that's one of the reasons that we were able to increase hog prices in 2008 compared to 2007, even with a 6% increase. This is what our exports for January through March have been this year. Japan up almost 10%, Mexico almost 60%, Canada was down 2.5%, China, Hong Kong down 63%, South Korea down 9%, Russia down 44%, and Australia up 48%. Australia is becoming a fairly important market for us. Hog imports and exports. We import quite a number of hogs. Of course, they come from Canada. That has, you look at it on a weekly basis, that has tailed off since 2008, reaching a peak there in early 2008. A number of things probably have contributed to that. Cool has contributed to it somewhat, but also a change in the value of the dollar has influenced it some. If we look at the net pork imports, this is where we only go back to 06 here, but if we go 20 years beyond that, we would have had a figure that would have been up. That would have been up in here somewhere, if I can get up in here somewhere, a positive net import of pork, and to here where we actually, you see, was 22% net export there in the summer of 2008. And at the present time, we're running about a 15% net exporter. You see, what that has permitted the hog industry to do is go from about 22% larger probably now than it would have been if we had pork imports and exports similar to what we had in the mid-1980s. Exchange rate, one of the things that has improved things for Canada a little in recent months has been the increase in value of the U.S. dollar relative to the Canadian dollar. You can look at that this way. The price of hogs in Canada are really set by the U.S. If they sign a contract in 1990 for $100 per hog, they would get $120 in Canadian dollars. By the first quarter of 01, that was up to roughly $160. And then it went from that back to actually $100 Canadian for each $100 U.S., and now it's back up to somewhere 125 or something like that. So exchange rate is very important to both U.S. and Canada. Our hog slaughter capacity is such that we had no troubles last fall, and we don't expect to have any problem in the near future. One of the things we have to worry about if we do downsize the herd 10% is we're going to have substantial excess slaughter capacity, and we have to be concerned about losing a slaughter plant or two. Demand. For some reason, demand appears to cycle. We think that's tied somewhat to the value of the U.S. dollar and exports, but notice how pork export demand there has fluctuated as we've gone through the years, with growth period here, some lost periods, then growth period, lost periods, and then growth period. We're back on the negative side for the first 4 months of the year. Export demand is down 5 or 6% or something like that. Change in export pork demand, and what we have on there is in the red line is the value of the U.S. dollar or the yen relative to the U.S. dollar. That fits about as well as anything we can put on that. And let me emphasize, when we get to talking about demand, this is something that we have a very limited ability to forecast with accuracy. We can do a much better job as far as the supply side than we can demand side. Change in domestic pork demand, as I indicated earlier, you see we're actually on the positive side here as far as the first 4 months of the year is concerned. We have basically a flat beef demand for that 4 months. Both broiler and turkey demand is up a little. So again, emphasize our problem is not demand, it is supply. Change in hog demand, as I indicated earlier, we're down on average of about 3% for the first 4 months of the year. We appear to be moving down the chain somewhat as far as the price cuts that we buy. I have a few slides here to show you the choice boneless retail steak as a percent of ground chuck. And notice how that has tailed down since 2005. The same thing for pork chop relative to our ground chuck. The same thing for chicken breast. Only that has turned around in recent months and has moved up a little. Inventory reports. before I give you the March and April data on that, we think the breeding herd on June 1 was down 2%. We're hoping it'll be down 3%. This shows us the Iowa profits, and notice that we have a couple of months of profit here last year, but I think we're on 21 months or something like that now as far as profit. Now, a part of that, of course, the increase in production that we've had is brought about by, look at that long string of profits that we had in 2005, 6, and 7. One of the longer time periods that we've ever had as far as profitability was concerned. U.S. breeding herd on March 1 was down 3%. Canadian herd was down 6.2%. The market herd in total was down 2.7% in the U.S. and down about 8% in Canada. And one of the reasons for Canada being down more in market herd than they are in breeding herd is their exports to the U.S. We're hoping that the market herd will be down 3% on June 1. And that may be more of a hope, Joe, than it is actually what we will have. U.S. farrowed by quarters, this shows us our cycle somewhat. Again, remember in this growth period that we've had here in 2006 and 7, that productivity growth has added to that about 2% or a little better, you see, per year. U.S. pigs per litter by quarter. We're just doing an astronomical job of saving pigs now. With, you see, up the last few quarters that we've had a short 2.5% just in pigs per litter. South farrowed U.S. and Canada, again showing the cycle. 4-week moving average as far as sow slaughter. We're hearing that sow slaughter is picking up this week. Our most recent data we have there, you see it's languishing along roughly 15% below a year earlier. So we've actually in recent months had less sow slaughter than we had last year. A little bit of that is due to less sow slaughter, less sow imports from Canada. This is data that about 60% of the U.S. slaughter capacity that we get a sample from as far as the mix of Barrows and Gilts. This data says that we've basically marked sideways in the last 3 months. Barrow and Gilt live weights, I indicated earlier, we're up 4 pounds or something like that, or 5 the last week that we have data for. The carcass weights are up 3 to 4 pounds from a year ago, and again, adding to a supply when we need to be retracting. Prices. Note that we had started rallying here in early April as far as price was concerned, and right on top of 2008 as far as the rally is concerned. Now look at what has happened since H1N1. So we basically moved sideways. We're hoping we still get some seasonal rally. We can't be positive that will occur. Barrow and Gilt negotiated prices. Notice how we've moved below a year earlier. In the first 4 months of the year, live hogs prices were actually above a year ago. Our forecast as far as slaughter is concerned is about 26.7 million, or 4.4% less than last year in the second quarter, about 5% less in the third quarter, 3% in the fourth quarter, and down about 4% as far as the year is concerned. Actual pork production is going to be down less than that. Forecast prices, carcass, Iowa, Minnesota, 58 to 60 as far as the second quarter. And again, we hope that we'll get third quarter up a little, 62 to 65. Fourth quarter, 57 to 61. 59 to 61 as far as the year is concerned. If you relate to that better in live prices, this is what it looks like with a 45 to a 47 average for the year. Now, you want to look at that relative to what the producer's facing. We've got somewhere in the vicinity of a $52, $53 cost that we're going to have. I was asked this morning if there was anyone in the hog business making money. Yes, there is a small percent that are making money. Those that have used the futures market well are doing fairly good. For example, earlier this week on the hog slaughtered, the contract tied to the futures market that you can sign with a packer, the people that had sold hogs on that and were delivering them that day averaged $77 per hundredweight in the carcass. And our costs, you see, are somewhere in the low 70s. So we do have people making money. It's not a very high percent. Non-swine flu. The top line is what the futures market was projecting on 4/24 for the futures market. The bottom line is what has happened on a daily basis as far as the actual hog price. So there's just no question that it has had an impact. This is the best we can measure what the impact might be for the summer as far as the swine flu is concerned. And what this is doing is looking at the price we had on May 24th and then 5/29, and then making estimates as far as slaughter is concerned and giving you a total figure there of just roughly $500 million. Forecast change in meat production. This is for 2008-9, probably in the ballpark. Here's 2010, and we certainly hope, and we think the odds are very low that there will be, that USDA is incorrect here. Note that they're forecasting a 0.5% decline. That will not be nearly enough, so that we have to get substantially more than that to get in the black. Summary. Barrow trending down, continued productivity growth, fewer imports of Canadian hogs and pigs, decrease in pork exports, weak domestic demand, high feed costs, red ink for producers, and the bottom line again is we have to reduce the herd 5% minimum and maybe 10%.